Good afternoon, social media friends, business partners, and many others who we don't know as well yet. Welcome to our episode today, where I have invited a couple of my connections to participate in this episode of Solutions Experts. So if you will bear with me for just a few seconds, let me move them from the guest green room into our studio. 1 second. Good afternoon, gentlemen.
Good afternoon.
Good afternoon, Bill.
All right. Thank you, gentlemen, for sharing your time with me, my audience, your audience today. And as I hinted in the kickoff message for today's video podcast, it's my pleasure to host the two of you so that we can share with the world, as small or as large, a unique solution that you guys bring to potentially a very large audience. And so with that said, if I may ask Scott Lamort. Scott, why don't you lead us off with a quick introduction as to who you are, and then we will do the same with Mark. Okay.
Fantastic. My name's Scott Lamort. I'm the Vice President for Business Development at the Itasca Bank and Trust Company. You mentioned unique solutions. We are a unique bank. We are approaching 75 years old. We are a locally owned independent bank, not part of any larger banking system. All of our decisions are handled locally with our headquarters in Itasca and our second location in Roselle.
Perfect. Thank you for telling us who you are and what is your role there at the bank, Scott. And Mark, now you. Tell us what you do.
Great to be with you. I'm Mark Stelter, and I work with Scott along with many other fine folks here at Itasca Bank. We provide a wide range of products and services to both consumer and commercial clients. The niche or corner that I work in is primarily with community associations, condominium, townhomes, single-family associations, cooperative type associations, and we provide financing for common element repairs. I've been here just a little over 20 years, and I brought it with me when I came over, and so far so good.
Wow. What a great introduction. 20 years. Mark, you're kind of like a lifer.
He was 9 when he started.
There you go. And Mark, it is for that reason, your introduction, that I benefited from Scott introducing you to me. Why? Because in this episode labeled Solutions Experts, I wanted to make sure that I, having served in various capacities on homeowner association boards, I want to make sure that my friends who may be serving on HOA boards, as well as my social media connections, my business partners in the business of real estate, I want to make sure they hear and they benefit from what you can share with all of us today. Is that all right?
Sure.
All right. So as part of our conversation today, what I like to do is just, play the casual host. I'll throw some questions at you, some easy, some maybe not so easy, in my opinion. And then you can help us out with getting smart about financing solutions for HOAs. All right?
Terrific.
All right. Let's start off with the first question. Why do HOAs need to benefit from the solution you provide, Mark?
Well, when a community association, when they seek out a lender, it's generally for one specific reason. They have a common element that needs to be repaired or replaced, and they don't have the funds to do it. So it really just is it's a pretty simple math equation. You know, we have a project that we're facing. It's going to cost X amount of dollars, and we have Y amount of dollars in our reserve fund, and that's not enough to make the repair. So at that point, the association board of directors and the officers, they then seek out a solution, and that solution is really going to be one of two primary options. The first is going to be that they're going to levy what's called a special assessment. And if you think about assessments, if you've lived in a community association, you write a check or you have an automatic draft come out of your account for the operating assessment to pay the bills. The community associations are always touted as maintenance-free or worry-free, stress-free type living. And the reality is that only occurs when the funds are there in order to pay the bills. So the operating assessment that gets paid every month, that goes for insurance, landscaping, the general operating expenses, the day-to-day type repairs. Maybe a professional manager is taking care of the property, so that takes care of the salary for the manager. But then when it comes to a repair, and by a repair, what I mean is something large scale. The elevator needs to be repaired or replaced. The roof, the two most typical are roofs and siding. We live in a 4-season climate, so we have a lot of construction material that expands and contracts through the 4 seasons. Moisture gets in or cracks start to appear, and there needs to be a repair made. So when the board faces that issue, they have the option of going to the unit owners and saying, okay, this is going to cost so many dollars. We divide that over the ownership base. Write me a check in the next 60 to 90 days for the dollar amount, and we'll make the repair. Well, there's quite a number of people, unit owners, who might not have access to those dollars, or might not want to liquidate an asset or an investment for that expense. And so the second option is to seek out a lender that would provide those funds for the repair, and then give the unit owners an option to pay not the operating assessment, but a special assessment is really what it's called. The board creates a special assessment and allows the unit owners to pay 40, 50, 100, some dollar amount every month over a period of time. The most common time frame is typically in the 5 to 7 or 8 year time frame.
Okay, got it. Now, because I know you guys are headquartered in Itasca, Illinois, are most of your HOA clients who benefit from this solution, are they really just in the Chicago suburban metro area?
Yes. So our every bank has an investment. They call it a community reinvestment area, or their primary area that they lend to. The bank is allowed to define what that area is, and then they're expected to make loans in that area. Mm-hmm. So ours is DuPage County and Cook. So we lend to associations that are primarily in DuPage and Cook County. Now, with that being said, we've certainly lent money to associations outside of those two counties, but our lending area really is restricted to Illinois. We'll go north to the Wisconsin border, we'll go east to the Indiana border, and then we'll go west to about Route 47, maybe a little bit further, but that and south to about 80, I-80. So if you picture that in your mind, that's our primary area, but we really try to focus on Cook and DuPage counties.
Okay. Is there a range on one end small to the other range large? Is there a range of HOAs and their unit count that you try to stay within? What can you say about that, Mark?
Well, and I appreciate you asking that. If you drive throughout Chicagoland, there are community associations, primarily condominium associations, especially in the city of Chicago. I mean, if you travel throughout any neighborhood, south, west, north, northwest, whatever it might be, in the city. I mean, Chicago obviously has been around for a long time, and there's been development from the beginning. And so no matter what part of Chicago and the suburbs that you're in, there are community associations. And depending on the developer, that can range. I've seen, 2-unit townhome associations.
Okay.
Basically, it's just 2 units. And you look around the city, and there's associations up and down Lakeshore Drive and Sheridan Road that are just massive. They have hundreds and hundreds of units that comprise the association. So Chicago is, fortunate because it really offers a community association for really every taste, every preference. And so when you get to the smaller end of that pool, so to speak, it becomes a little more challenging for an association to obtain financing. A lot of our competitors, and we love our competitors because it's a small industry and everybody knows each other and we all get along great. It's just that every bank defines their own business plan, and our competitors tend to not be as comfortable at the lower end of the units for an association as they are at the larger end. And certainly that's explainable because banks measure risk. And I'm sure our competitors probably see a 12-unit association as a higher risk than one that might be 1,200 units inside. And so what we did is we just made a decision as a bank that we were going to not let this part of the market go unattended, because there really isn't another lender out there that's comfortable making these loans, at least none that I've come across, to, let's say, a 6-unit association. That's where we tend to try and set our floor, so to speak, is at that 6-unit level. And then we'll go up as many units as there are available that are out there. Although we do set an internal loan amount that we don't like to go above, but I've never come across anybody that needs that much money. And if I should say, not that I've never come across, but when I come across somebody that needs that much money, all I do is refer them out to one of my larger competitors, just as they refer the smaller associations back to us. So we try to together service the entire industry and just find the right fit for the right association, the right lender.
It's good to hear that there's co-opetition, meaning sometimes you have to cooperate with your friendly, maybe not so friendly competitors. And, you give as much as you may receive from your co-opetition partners, right?
Yep. Yeah, absolutely. And it is a very, obviously there's competition, and we do come up against each other in those middle areas where we both find that we want to be a part of the market. So we certainly compete aggressively with each other on many of the opportunities that come up. But then, when you get to the ends of, where we tend to be more comfortable, we certainly are comfortable sending referrals back and forth.
Bill, co-opetition is a great word, and I'm stealing it now.
And you can. Why? Because Scott, I used it from someone else that I heard from about that. So I'm all about repurposing, right? All right. My next question, Mark, is when you engage with a homeowner association and you're scoping out how am I going to deliver what they need from myself and Itasca Bank and Trust, what are the top 3 concerns or objections you usually hear from the association, from the board and or maybe the property manager that's relaying the info to you?
Well, it depends on the mood of the unit owners, and it depends on the mood of the board members. It really, there are many associations throughout the area that have very savvy board members. They do their homework, they do their research, they know what's needed, and they understand the fact that living even in a community association means investing into the property in order to not only keep the values rising, but also for life and safety issues. And so if I was going to list the top three, the first one is always the same, and that is how much is my assessment going to increase, and
True.
am I going to be able to afford that increase? And when we have those discussions with the unit owners and with the board members, I always kind of draw them back to the same example, and that is if you lived in a single family home and your roof was leaking, you would fix it. You would find the funds one way or the other to fix that repair. Because if you don't, it only gets worse. It only becomes more expensive.
Right.
And it can potentially then affect both the value of the property, and then it could also create a danger from a life safety perspective. So cost is definitely the first issue. The second issue is I'm just a volunteer on a board, and now I have to sign loan documents, and that could be a very challenging and anxiety-filled transaction, because I certainly see how if I was the volunteer on the board and I wasn't familiar with the process, that would be very something I'd want to approach with some caution. And so what we try to do is allay those fears and say, well, you're signing the documents based on the position you hold today. One of the nice parts about our loan documents for our community association, which is different than many lenders where they lend to a for-profit corporation, let's say, there's no personal guarantees. And the individual's not signing individually as the person, they're signing as the board member that they are at the time that the board entered into the transaction. And so that tends to be the next issue. There's disclosure issue of personal information that has to occur just based on banking regulations. It's not a Itasca Bank rule or request. We have to satisfy, as a regulated industry, our auditors and the banking regulators that have certain requirements of us. And so we try to give them a full perspective as to why we're asking the information that we are. So cost is going to be the first issue in terms of the special assessment. The why am I signing these loan documents as a volunteer as the board member to the association would be the second one. And then the third one is just the same as what you and I would have a concern if we were going to buy a home or get a car or something like that, is what's it going to cost? What's the interest rate? What's the association going to incur in terms of the interest rate, and what kind of terms are available to us? So the cost on the individual unit owner level, the issue with regard to me signing as a board member, and then the cost to the association in terms of an interest rate tend to be the top three.
Very well explained. I remember when I served in various capacities on a HOA board, treasurer certainly. So I remember having to look over, that encyclopedia thick, I'm just kidding, set of disclosures. And I also remember I had the same personal anxiety about what am I signing. I really appreciated how you answer those questions. And you're right. You're absolutely right. Because at the end of the day, when you buy into a condo unit development, I use the metaphor of Three Musketeers rule. All for one, one for all.
Sure. Yep. And that's a great way to put it, because when an association board is looking to make a repair, one of the most common objections, and this tends to come from people who are about to move out of the property. So I'm not going to be here next year. I'm going to sell, and I'm going to relocate to another part of the state or another part of the country or the world. I'm not going to be here. And now you're going to levy this special assessment upon me and my unit, and I'm not going to benefit long-term from the repair, but I'm going to have to make the payment. Yes. And so that tends to come up also. And it's certainly a valid concern. And the explanation for that concern is, Well, either you're going to get the benefit from the increased value of your unit because it's going to make your property more competitive when a prospective buyer is looking in the neighborhood at other community associations. Or you're going to be able to list the unit with that special assessment disclosed right from the beginning, and then just have the buyer potentially make the payments on that because they're going to benefit from the repairs.
Right on, right on. And you said it so well earlier, and that is maintenance is maintenance. You can't escape it. Deferred maintenance, when you defer it too long, is not good because simple problems, when left unattended, become bigger problems. And whether you own a single family home or you're in a development, HOA, building, condo, PUD, or otherwise, you're going to have to borrow the money somehow, some way, unless you have the cold hard cash yourself. So I really appreciated how you kind of broke it down that way. My next question is, besides the condo board, the individuals that make up the board as the point of contact and the people that you need to converse with, who are what I call referrals or influencers that you work with to get into the arena of providing this solution, Mark?
The entire industry revolves around the property managers.
Right.
I mean, I'd be searching for the remaining days that I have trying to find board members, and it would be a futile effort.
True.
Because not every association needs a loan. In the case of many of my competitors, they offer on the other side from credit, they offer a lot of cash management type products. So if you think about a utility bill, we're moving quickly out of the phase of writing checks. But for any of your viewers that either still write checks or remember writing checks, when you paid your gas bill or your electric bill or your cable bill, let's say, you typically wrote it, put it in an envelope, and it went to a P.O. box. Well, the utility company doesn't operate out of a P.O. box. They are contracted with a third-party payment processor that's handling that payment. So that is, though the property managers that manage the properties are the companies that are setting up those payment processing arrangements. So a typical property manager or management firm in the Chicagoland area, they might manage 15 properties, or they might manage hundreds of properties, depending on the size of the firm. And there's literally hundreds and hundreds of residential property management firms in the Chicagoland area. Every vendor that wants to do business with a community association is acutely aware that the only way you're going to be able to get in front of the decision makers who are going to ultimately buy your product or service is through a property manager.
Right. Very true. Very true. And just today, certainly when I'm not hosting video podcasts with my other business, I do have to speak with property managers, sellers attorneys, buyers attorneys, real estate brokers. So just within the previous 30 minutes, I had to have a conversation with a third-party property manager asking about something that is important enough for us to go forward. So right on. I'm right there with you. As we wrap up, Scott, what more would you like to add to share a bigger picture about what you do business development wise for the larger whole of Itasca Bank and Trust?
Sure. I want to make one more statement that Mark sort of tapped onto when he started talking about cash management and other banking products.
Okay.
I think one of the things that often gets overlooked in these types of conversations, we focus a lot on why you get a loan or why you need to apply and et cetera, et cetera. What we don't talk enough about, and Mark and his team deserve some credit for, is the white glove level of service that comes after you take out a loan with Itasca Bank and Trust. This bank has a dedicated team of resources that work with Mark to make sure once the loan's in place that everything's handled properly. It's a service industry. It always has been, right? A bank is a bank is a bank. A car is a car is a car. It's the service you get with it, right?
Right.
That speaks to the culture of Itasca Bank and Trust, and Mark's team does a great job working, seamlessly with property managers in the city and in the suburbs. So I commend both Mark's team and the bank for doing that. So if I could that's where I go.
Yeah, and those are kind words, and I appreciate that because Scott on a larger level is really describing the bank as a whole, because we really do strive for that top tier level of service that we provide to our customers. I always give out my cell phone numbers on my business card. It's on my email signature at the end of my emails. And I always tell the managers and the board members, if you have a question and you're working, then I'm working. So if it's before hours, during business hours, after business hours, and I get calls at all different times of the day and over the weekend, we don't exist without the property managers and the board members that are giving us the opportunity to provide a service and a product to them. And so we don't work within the old banker's hours that we still get chided about periodically. We're working all the time.
I certainly appreciate that, because just like the two of you with my lending business, let's call it like it is, while what we provide is usually perceived as a commodity.
Correct.
The service and the experience that we drive to deliver for our clients is what makes us more unique. Right on?
Yep, right. Absolutely. Well said.
All right. Now, before you guys leave the studio, let me move our podcast to simply share a few seconds from our sponsor today. So sit tight, gentlemen, and I'll come right back to you.
Sounds good.
Thanks, Bill.
All right, a few words from our sponsor today. When and if social media friends, business partners, and many of you who we don't know as well yet may be looking to finance the purchase of a condo unit, a PUD, or even an investment property where there is a HOA, please consider Planet Home Lending. Our team will get you home. So let me now move us back to our guest today. All right, gentlemen, as we wrap up, I wanted to simply say again, thank you for sharing your time with me today as your host, with my audience and yours, who should know more about your unique solution as a solution expert providing financing solutions for homeowners association. So Scott and Mark, as I wrap up today's video podcast, thank you so very much for joining me today until we see each other again very soon.
Thank you very much.